All right, you heard him. 561-291-8569 is the anytime hotline. And by anytime, I mean literally anytime. It rings here in the studio when Dom and I are here at the show, and Dom's my producer. And it pushes to my office during the week. So if you have questions, that's a great way to get us. 561-291-8569, or as always, the website, www.mr.mortgage. There's never a .com, just type in mr.mortgage. And you'll find us. So yeah, I mean, we talked about the Jan phenomenon. So instead of stomping your foot and yelling Marsha, 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 there might be a chance to capitalize on some of that equity for home improvement. So last thing I wanted to touch on, I got a little bit sidetracked there with Jan, was with what's going on in Europe, there's a lot of Russian investment in real estate in the States, and in Florida primarily a lot. So there was a study released, or a report. I call everything a study, but a report that NAR, National Association of Realtors, released this week, that there's some curiosity, if you will, what's going to happen to the Russian investor. We see in the news that the yachts are being seized from the oligarchs, and we're definitely putting pressure on Russia in that aspect. So what's going to happen to their real estate? And they're cautiously watching that. And I just found this interesting. This is just kind of an oh by the way, but 29% of Russian investment in the United States real estate market is in the state of Florida, 16% in the state of Georgia, which really surprised me, because for some reason I don't imagine a Russian guy with a pickup truck and a six-pack running through Georgia. But hey, I'm a Florida hillbilly, so I'll be right out there with them. But yeah, 16% in Georgia, 13% in New York, which again surprised me. I thought that would have been higher. 8% in California, and 5% in Illinois, and the rest is split up over the country. So it'll be interesting to see if there's some seizures on the real estate side. There doesn't appear to be any pressure there now. There was a report in Forbes magazine. Dolly Lentz is one of the top mega agents for that multi-million-dollar international investor, and she was quoted as saying she's getting a lot of phone calls from Russian clients who are wondering if now is a good time to sell. So if you got 15 or 20 million laying around and you want to pick up a deal, you might want to give one of your Russian buddies a call and take that property off his hands. But we'll keep you up to date with that. It's just kind of a byproduct of the international world that we live in, and in the Florida real estate market in particular, there's a lot of international players. But yeah, so as promised, we're going to jump into questions. I know Dom is alerting me that we got one queued up, so I'm going to throw it over to Dom and see what we have on the question line. What do we have, Dom?
All right, we have Sue from Port St. Lucie. Sue is asking, is it better to do a cash out refinance or to get an equity line? I have a great credit, if that matters.
Hey, Sue, that's a great question, and I'm assuming that's following up on what we just talked about, right? Pulling some of that equity out to do some work around the house or pay off some bills. So there's not really an easy answer to that question, with the exception of what are you going to do with the money? If you just want to set it up, the equity line that is, so you have an emergency rainy day fund, absolutely. That makes a lot of sense, because there are often no closing costs, if so, very little closing costs with an equity line of credit. And then you don't have a monthly payment with that equity line unless you actually use the money. So it's basically like a credit card that's collateralized by your property. It's exactly as it sounds, a line of credit. So if you just want an emergency rainy day fund, that may make sense. But if your thoughts with an equity line of credit are pulling money out to invest in the property and into your home, you're going to want to ask yourself, how reasonable is it that you're going to pay that off in a relatively short period of time? Are you going to pay that, pull a chunk out, redo the kitchen, and then do you think you can tackle that debt over the course of the next 5 years? Then it may make sense. But if you're looking at big expenditures and you want to stabilize that monthly payment, because I guess one other thing I should probably touch on is typically the equity line of credit is often interest only, most of the time for about a 10-year period, but that interest rate floats. So we all know what's going on in the interest rate environment that we're in. They're going up. we are at the bottom of the interest rate environment from now forward. Yes, they were lower last year, but they're going to be higher next year, especially things like equity lines and credit cards, because they're governed by other actions in the market. So anticipate that your equity line interest rate is going to increase over the time that you have it, and then do that payoff calculation. How long will it take you to pay it off? There's going to be, a break-even point or an inflection point, if you will, where it makes more sense just to roll it all into a fixed rate mortgage product, so you have that stable monthly payment. And from the sense that you're using it to reinvest in the property, theoretically gaining more equity, it's not at all bad advice to do that. And most importantly, that interest rate in a fixed rate product doesn't change. So think about it that way. There's some super enticing equity line rates out there right now, because they're typically tied to the prime rate. And depending on your credit score, it may be prime plus, a point, or prime plus 2 points. Sometimes it's prime minus. There's really not a lot of room on the minus side right now, but when rates were 6 and 8%, we saw prime minus equity lines. But yeah, I would need to have a discussion with you, a little deeper talk about what you want to do with that money before we were able to adequately assess whether it makes sense to do it in a cash out refinance or in the form of that equity line. And listen, there's nothing stopping you from doing both, assuming that you don't, pull out too much equity in the cash out refi. If there's additional equity left over later, you could always do that emergency rainy day strategy to put the equity line in place. But I have to also share too that if property values ever go down again, as they did in the crash, those equity lines get called. They'll turn it off. They'll turn the spigot off. If your equity line was approved to 80, 90, 100% of the value as they were back then, and you might have $100,000 of unused credit in your equity line, and then your property values go down and the bank reassesses the risk level associated with that equity line, you might get the phone call that says, hey, we're going to close out your equity line. There's no longer enough equity in the property to justify it from the bank standpoint, or they may reduce it. So just all food for thought. And then lastly, I guess let me share this. Most equity lines have what's called it's not a prepayment penalty, but it's an early termination fee. So if you take the equity line and you did some quick renovations and sold the house to pay it off, that's where you'll pay the fees associated with the equity line. It's an early termination fee. But great question. I'm assuming it was following up the first part of the show. That's why I went into the conversation regarding what you're doing with it. If it's improvements, it may make sense just to do the cash out refi, roll it into a 30-year or 15-year mortgage payment, capitalize on these ridiculously low rates, and you've improved the value of your property. So hopefully that helps. I know there's a lot of people trying to figure out what the best way to use that equity is, and you hear me talk about it a lot. We talk about the REC loan, where people are reducing, eliminating, and consolidating is what REC stands for. So we're taking your overall monthly your overall monthly debt expenditure, and including everything in it, your credit cards, your car payments, everything. And we're looking at the equity in the property. Does it make sense to take all of those payments and reduce them into one, maybe even eliminating them, but certainly consolidating them all into one payment? And does that dramatically reduce your monthly outflow? In the REC refinance world, it's less about interest rate. There's certainly that component. We don't want you to pay more interest than is unnecessary on your mortgage, but you're looking at basically a cash flow position in the REC refinance. And a lot of people are doing that with their equity and paying off those RVs that we all bought because we were going to travel the world during the pandemic and watch the beautiful sunsets in California. And we all had these grandiose ideas that we were going to live off the grid. So if you've got that RV sitting there collecting dust along the side of your house and you want to pay that off, maybe the REC loan is the way to go. But hopefully that answered the question. I know there's often a lot more to the information we need to answer it, but yeah, if it's gonna be something you pay off quickly, then the equity line may be the way to go. But we'll be back on the other side of this. 561-291-8569 is the Anytime hotline. 561-291-8569.